All right, so today we're going to talk about the Fed rate hikes yesterday. I think a lot of you, maybe you had a chance to tune into our live stream of that or the restream. And really the question is when to buy crypto. Are we in a potential scoop off the bottom? We'll break all that down today and give you guys some insights to it. I've got a good analyst in today on the show, so I think you're going to love it. Again, my name is Paul Vera. Welcome back into TechPath. Joining me today is Mr. and Dr. Jeffrey Ross. He comes over from Vailshire Capitals. He's been on the show many times, so we call him Dr. Bear. And thanks a lot for coming on the show, Jeff. How are you?
I'm doing great, Paul. Thanks for having me on.
Yeah, excellent. All right, so Jeff, let's just get into it. I mean, yesterday was an absolute just shambles across the market. I'm just going to jump to this CNN business story right here. So did he just bust the stock market rally? I think a lot of people were even kind of commenting during the questions portion of the meeting, and they actually said, "Hey, there's a little bit of a rally going on." It was almost as if Powell kind of doubled down on all this. First of all, your initial viewpoint of the meeting and whether or not you think we're going to see any sort of easing up this year, and I'm talking about primarily, obviously, with December being our next report.
Sure. So yeah, yesterday was an exciting day. First when the statement got released, first of all, they raised the federal funds rate 75 basis points. That was not a surprise to anybody. But then their statement came out and sort of tilted a little bit dovish, and so the markets initially interpreted that as a very good thing. So they initially rose. I was lurking in rooms and watching different news programs for the next half hour before the press conference to see what the response was. And most people uniformly were interpreting this as a bullish sign, which was really funny because then in came Powell and he came out with his gloves on. He was doing his best Mike Tyson impersonation. I mean, he just pummeled the hopium out of any bulls. And he really did, and I think he was very intentional about that. He said we should not even be thinking about or talking about a pause yet, not even a pivot, a pause. Like we shouldn't even be thinking about a pause yet. He said the terminal rate is actually higher than what we had initially thought it would be back in September. He basically set the stage for, look, you guys, inflation is sticky high, higher than we thought it would be. We are going to actually have to raise the federal funds rate higher than we thought we would. And this is hugely important, we're going to hold it higher for longer than most people think we're going to have to in order to tame inflation. So that is not what the bulls wanted to hear. That was not hopium at all. The markets took it as for what it was at face value, and they just got pummeled. And so I look at that now and I think, is there any chance that they will, slow stuff down heading into the end of the year? No, I think definitely we're going to see either a 50 or a 75 bips hike in mid-December, and then we'll see what that does, and we'll see what the inflation numbers how they come out after that. But basically, we're kicking this can and this business and this discussion further down the road into 2023. Absolutely, there's no way that I think we get a strong rally in risk assets to end the year.
Yeah, so, and this isn't kind of a I told you so kind of moment, but we've been talking about this here on the show for quite some time, is that November is a concern, has been for some time now. We're going to get a chance to see that play out after the October numbers, which were, fairly decent in terms of overall performance. But I was looking at further in the article right here. It was kind of interesting. What we did see was a more hawkish message through the markets that anticipated, which is exactly to what your point. Essentially, it killed the pivot dreams, which, to the point you're making right there. And I would agree, but let me ask you this. So we were live streaming this, and during the live stream, first of all, he kind of came out a little bit on the front of he could have gone either way. And then as the stream went further into it and the questions continued to come in, it felt to me like there was almost a switch that simply gave him, and he literally just reiterated time and time again toward about midway to the latter half of that meeting that this was absolutely not going to be the case. I mean, that to me sent a huge message moving forward in the traders, I think, for the market itself. But do you feel like that we really got a full response of what we're really up against right now initially, or you think the market is going to take some time to really digest that?
I think the market is interpreting it correctly, but we're not there yet as far as how serious this is and how much further this has to go. One thing I look at closely is what is the 2-year Treasury yield looking like, because that basically historically
Right.
has served as a cap of the federal funds rate. We've talked about this in the past. It
Yep.
has shot up. It was actually sub 450. It was like 448 or something when people were feeling good about the comments
Hmm.
after they released the FOMC statement. But then it quickly shot higher. To your point, once he started talking, once he took the gloves off and got the eye of the tiger and said, you know what, I'm gonna do this and be extra hawkish. The 2-year Treasury yield took it seriously. So the bond market participants said, oh, this is for real. Inflation is going to stick around for longer. They are going to raise the federal funds rate higher. So right now, as we're talking, it's up to 4.708%,
Right.
meaning that, the rate currently is at 4%, meaning that they're saying, okay, we've just given you another 70 basis
Hmm.
points to hike. I think that goes up past 5% in the next couple of weeks, and probably going to even go higher than that. And so, yes, the bond market's taking it seriously. He did get a little twinkle in his eye, and I even caught a couple little smirks when he said something like, I control the message. And then he said another thing about basically saying, yes, I'm going to destroy the markets, but we have the tools. We've shown in the past, we've proven that we can quickly turn things around if we need to. In a snap, we'll fix it. But first, we need to have this deflationary bust. And he had a little twinkle in his eye when he said that too. So
Let
it's
me
very
let me
interesting.
ask let me ask you, okay, because this is to me, I look at the Fed and I think, what tools would you say would they deploy should they be in a position where they have to see an opportunity? Because right now, the scenario is going to be, I think, continuing. We've talked about it many times on the show. The Q4 is not really even in the cards, in my opinion, and really Q1 will completely, I think, depend on what earnings come out of Q4, because we could see continuous depletion of, and really a bad holiday season, which would kill retail sales. Obviously, we'll see a lot of impact around pricing, which could lead to job loss, which is the other factor we'll talk about in a minute. But when you look at that, how do you see that playing out in his scenario with a tool set to try to fix this in a
Yeah,
quick
fix
way?
it. Yeah, what does fix this mean, by the way, right? Fix this means slow the economy down, destroy demand. The huge important piece to this that rarely gets discussed is the human cost of suffering, right? That
Mm-hmm.
means people are losing jobs, they're out of
Yep.
work, they just don't have the money to buy things, which that brings demand down. If people can't buy things because they have no money, then prices come down. That's one way to fix inflation. I think it's a really barbaric way to do it, but that's the way they've chosen to do it. And so I look at it, I think it's possible we're a little bit surprised at how strong the economy continues to be
Right.
into the
Yeah.
fourth quarter. I think we may actually have a decent holiday season. I think that we're going to see the bulk of our worries and the bulk of the troubles with our economy in the first half of 2023. And so
Mm.
that's why I think this story gets pushed out for longer. And I think that's what he's hinting at as well. We may just continue to push rates higher. It may be slightly at a slightly slower rate, but we're going to get going to hold them higher for longer.
Right.
So we're probably going to be talking about these issues all the way into the spring and even the summer of 2023.
I was looking at your tweet. It says you're obviously biased, but from perspective, the only hope for equity bulls in the coming weeks and months is the occasional counter trend. This is a potentially oversold lows type thing. There's a handful of those investments that are out there right now that I would say are in oversold positions. Many people would look at the crypto market right now and being oversold positions. Are there any things that you guys are looking at for that as we start to continue to fade through Q4 and possibly Q1 that could be a play that Vailshires and your team are really kind of focusing in on? Where are
Yes.
you watching?
Sure. So great question. So we continue to focus. I like the growth innovation tech sector. So we focus on that. For us, an easy way to focus on those for our clients is just by either kind of long or short NASDAQ type equities and those things. And then also the Bitcoin space, Bitcoin infrastructure, exchanges, those sort of things.
Mm-hmm.
All of those categories are still very much in bearish momentum based on the indicators we follow. So for me, the easy trade continues to be hold large short positions in these, wait until they get to their oversold levels when we're getting close to those again right now, take lots of profits, reduce position size, and then just wait for about a month or so for it to back up. It'll be another typical bear
Right.
market rally, back up kind of to the top of the channel, and then you just do it all over again. And that's what we've been doing for quite a while now. A couple other things I just like to mention to people, not everything is in a bear market. A couple things are still holding bullish, which is pretty impressive considering how tough the situation is out there. Oil and gas stocks, energy stocks themselves are actually holding up
Right.
pretty well in specific ones. We hold a few in our portfolios. And then the healthcare, which tends to be a defensive sector, biotech stocks are actually just barely starting to look bullish again. So those are some areas that we're starting to nibble in. But mostly for the vast majority of our portfolios, we're very short right now.
I think what Jeff just said is this is really, hopefully if you guys are listening to this maybe after the live stream, play that back, because his whole position there in terms of how to trade this market, I think, is really spot on. It's with what we look at even here in our own crypto pit a lot in terms of short positions and being able to play the market in these very short periods of times to take profits when you can and be able to kind of jump in. So it's not as if the market is not tradable right now. Of course it is. There's a lot of opportunity out there. But at the same time, what we're watching for is, where is that bottom? Is the bottom in? Those kind of things that people are going to continue to question. The macro pressures are still here for sure. I want to jump to jobs real quick. This is a story from Bloomberg. U.S. job loss claims hold near historic low despite the cooling economy. So, not a lot of people losing jobs just yet. So again, this is the factor that the trailing indicators, when you start to see those job losses, even though they're still not being lost, but the fewer job opportunities are being reduced, because then you have that pivot in the job market where now you have job loss and you have rising prices, and now you're in stagflation. So do you think that's something that could play into the scenario in Q1 or Q2 for next year?
Yes. So first of all, that's part of the problem right now, right? Is that good news is bad news. So good economic news, meaning that unemployment is still historically low. Because unemployment is low, that's bad news for risk assets, because that means that the Fed is going to remain sticky hawkish for longer. So that's the problem. Good news is bad news. When will we see this start to see a spike in unemployment? I think that officially gets pushed into the first half of 2023 again. So I think we'll be talking about a real recession with rising unemployment numbers, with the things you talk about, first half of 2023. I think we're going to make it through 2022 without an official recession. We had our little technical recession in the first 2 quarters with negative GDP growth, but I think the last 2 quarters of this year are probably going to turn out. Third quarter was positive. We're probably going to see a positive GDP growth for the fourth quarter as well.
Your thoughts on that, with the potential of stagflation? Could we enter into a short zone in there where we are seeing rising prices, but even though the market is cooling off and we're losing jobs in the market, demand is down and prices are up? So that being stagflation, could that happen? And if it did, would it hold very long within that recession?
That's definitely the issue, and I think that's what Powell and the Fed fears the most, is that we get into this period of basically, systemic inflation that we can't get rid of, and then the economy is shouldered with so much debt and so many issues that they just can't pull out of it, that GDP can't pull out of it. We're going to be talking a lot about that. So will we see it? Possibly in 2023. We may have stagflation, and that may lead to this deflationary bust that we're talking about kind of in the short term. A lot of people, when they're talking about stagflation, they're talking about like for a decade or so. I like to think in terms of quarters. And could we have sort of a quarter or 2 or 3 where we see basically very slow or even negative GDP growth mixed with high inflation? Absolutely. And in fact, I think that's going to be kind of the story of 2023.
I want to jump to a video here by Christine Lagarde. She's the European Central Bank president, and she makes a very big statement here around warning how maybe this recession may not actually fix the problem. But listen to this clip real quick.
We do not believe that recession will be sufficient to actually tame inflation, and we can just let things roll out as it will be. We need to continue to deliver on our mandate and to find that interest rate that will help us reach the target that we defined as the 2% symmetric medium term. We have to be mindful of each other, and we have to be attentive to potential spillovers, spillbacks, as I think the Fed is also mindful of. We are not alike, and we cannot progress either at the same pace, under the same diagnosis of our economies. We do not believe that recession will be...
All right, so let me pause that one so it's not playing. So she kind of wrapped it up right there, is that this may not be a corrective measure that could even pull us out of this kind of scenario in terms of taming inflation. do you feel like it has to be a supply side for this to actually really be impactful for the economy in the future?
I do, and that's what I've always been pushing for. I mean,
Or
we should
demand
be
side?
tackling this from the supply side. We should be looking at ways to grow the economy, grow our way out of that, even if it means higher prices in the short term.
Mhm.
What Christine Lagarde mentioned there at the very end, what she's talking about is we may be, just to your point, we may be in a horrible stagflationary period where we are actually in an economic recession and inflation still remains sticky high. And then what do we
Right.
do? Now we're really screwed. And so that's why I keep saying, this isn't a monetary solution. What we should be doing is doing everything we can to increase the supply side, to get Americans back to work, to rebuild
Mhm.
infrastructure. Everybody knows that deglobalization is happening. Let's go
Yep.
all in, right? Let's go get boots to the ground. Let's pour money into it. Let's get people working. Let's rebuild American infrastructure and regain our dominance in the world, for the sake of the world. But of course we're not. We're doing everything else, and that's very frustrating to me personally.
Well, we've had a couple of videos on this whole deglobalization, trend that's happening, what this means to kind of the aspect. I think it really opens up an opportunity for the United States that we could see one of the greatest growth eras in the country's history coming at us again because of the potential for us, one, onshoring so much of what we've offshored for the past 3 decades and getting our country back into a position. So it might be interesting if we play our cards right. Hopefully we don't get into a dystopian future that I've been reading about, these mega trends that are concerning to me. But I was jumping over here to Zero Hedge, and there was a good article here. Is the era of the all-powerful central bank, is it over? And if you look at some of the points they made in this, once finance dominates, then both the market and government become servants of finance. And kind of where we are right now. I mean, you look at the cumulative percent in real wages by wage group. We've seen, really a disparate position here between classes. And the bottom of the 90% has lost ground to just economically, but also politically and socially. So simply saying, you really only have a very small percentage of the population that have been able to gain during this last economic boom that we've had. Could the era of the central bank be coming to a close, or do you feel like that's just not going to happen? We're going to continue to see this kind of manipulation.
I think that we're seeing the early stages of this. So there are a lot. I have a lot of feelings on this, and they can go kind of either way. First of all, we're seeing the signs of the end of this huge Keynesian economic experiment, right? The whole point of Keynesianism is to increase credit, help grow the economies,
Right.
massively increase these growth cycles. The downside is you have these intermittent deflationary busts, which are really terrible to go through. But now we're at a point where the nations, and all nations around the world basically, have so much debt that they can't possibly pay it back in any kind of sound money. This is what happens in the final days of these kinds of systems, right? At some point,
Yep.
it gets to the point where, like, you know what, you can print your way out of this, but you're going to debase the currency so much that nobody's going
Yeah.
to want your currency. Then you have this crisis in confidence in the currency, and people look elsewhere to put their purchasing power. That's what's amazing about the timing, I think, of Bitcoin being around this time. So could this be the end of central banks? I think a lot of central banks are going to go away. The US dollar, again, remains the strongest currency. The central bank, therefore, is kind of the strongest central bank. I think it's going to stick around for a while. One of the things that is a great sign that we are in the final days of central banks, to your point, is the discussion of central bank digital currencies. They're like, you
Right.
know what, we need not only the whole problem from their perspective is we don't have enough power. We need more power. We need to be able to control the money. We need to be able to distribute it ourselves, and to have like rules based on this money. Like, you can only spend it if you're a good person and you have a good social credit score. And if you want to spend it on crypto or Bitcoin, you can't do that. We're going to block that transaction, and we're going to tell you what's good and bad, what you can do with your money. So these are final days kind of things. And at some point, the people just say, you know what? No, like,
We're
you've
done.
created so much income inequality. Our lives are so miserable. You've created this massive ultra wealthy class, and the rest of us are dirt poor. There's no more middle class. It's all because of your crazy policies. We're done. And that's when you see these overthrows and these huge societal shifts. And I do think that this decade is a decade of societal shift, that we're going to see, hopefully not kinetic war. I really hope we don't go to war and have, a World War III type event. But I do think we're going to see massive regime changes, massive societal changes all around the world throughout this decade. It's going to be very tumultuous, very volatile. Personally, I'm extremely thankful that we have Bitcoin to flee out of the fiat
Yeah,
system.
for sure. Yeah, I think that's one of the big things that and you guys are following our channel. We talk about this a lot in terms of the depth of where the finance system is going. Some of the technology that kind of is moving in this space. Back to this point in the Zero Hedge article, so central banks are preparing to deposit new money. This goes to your point, directly into checking accounts. Governments are pondering the windfall taxes, wealth tax, claw back some of that wealth that has been accumulated. Do you think that could be a potential here, where the tiger spins its head and said, wait a minute, we have a new prey in front of us, and it's the one that we've just created with trillions and trillions of dollars of wealth. Do they come after the rich? Do they come after the markets that are, because that possibly could be windfall tax and also an opportunity of kind of centralizing that wealth maybe into a new way? Is that even a potential reality?
I say absolutely. As they get more and more desperate, they are absolutely going to go after where the honeypots are. So they've
Yeah.
created these massive honeypots, to your point. They're going to go after these honeypots. But you know what's interesting is that the people who have these honeypots and the corporations and the countries, they're going to find ways to get around this. They're not going to be up for that. They're not going to say, "Oh, sure, you can tax me at 90%. Go for it." They're not going to go down without a fight. And so now we
Sure.
have a very different world, right? Now you can go into things like gold. You could get into the crypto system if you want. You can put all your money in Bitcoin, and there's not really anything governments can do
They
about
could
it. So
do, yeah.
very, very different world we live in now. So that's why I just think we get this big regime change and this move from centralized to a decentralized world.
For sure. I want to jump over to Ray Dalio. He says basically credit crunch is coming. It could tank the markets even further, could spark the full-on recession. So we have so many things playing into this right now, Jeff, and this is the thing that we've talked about. All of the trailing indicators, the job aspect, the real estate markets, what we've seen here around just the cost of doing business today with general business, which is going to reduce the scenario around jobs. But then you're dealing with the average consumer who's depleting their savings and probably barreling down, I think, a lane right now that's going to land up in a credit crunch position. How important is the U.S. consumer flowing into a real credit crunch part of this whole economic correction that we're in right now?
Oh, that's a huge part. And that's what we see. That's when we're in the depths of the recession. So I agree with Dalio. We're absolutely headed into a recession. And now that the 3-month and 10-year yield curve has inverted, which it did recently pretty sizably, I think it's imminent. So to me, that just says, you know what, we're probably going to officially be in a recession in the first half of 2023. That means that people are going to lose jobs. They're not going to have enough money to pay for just the basic necessities that they need. What do? You max out your credit cards. At some point, the credit cards just say, you know what, we can't give you any more credit. And then that's when things really, really get bad. And so I think the politicians are going to be discussing more things like loan forgiveness. Do we venture into credit card loan forgiveness?
Ooh.
That's a whole nother topic. But if people get desperate enough, they might do something like that. So I think all of these things are going to be fair game as we get further into 2023.
Yeah, Dalio goes on. He says, since the amount sold has equal to the amount bought, it seems most likely, all this is going to happen on the contraction in private credit, which would lead to a lot less buying of goods and services and financial assets. So all of this declines, and then this gets into the whole correction that we could be seeing, in 2023. My question is this: when you look at all of these factors playing into what we've talked about with the Fed, what we're seeing on the global stage, what we're seeing with ECBs, and then also back home here in the consumer side, what does 2023 look like in terms of shaping up? Is there any light within 2023 that could point us at least in the right direction?
I'm encouraged by what's coming in 2023 only because I think the bottom is coming in 2023. So that means finally that we're going to see an end to this. There'll finally be a light at the end of the tunnel. We're not there yet. And I keep telling people we haven't even hit the bad part yet. The worst is yet to come. Unfortunately, I'm not trying to be a doom and gloomer, but it gets bad. I think it gets really ugly throughout the first half of 2023. People are going to be despairing, losing jobs. Unemployment's going to go really high. Credit limits are going to be maxed out. All of these kind of things. Risk assets are going to get decimated. And then we finally bottom, and that's going to be a great day. So I don't know when that is right now. Based on the models I'm looking at, I'm thinking probably summertime of 2023. We probably hit a bottom, and that's when we can start being optimistic again. I don't think, by the way, that we're going to have a very rapid recovery. I don't think this is V-shaped. I think it will be kind of a slow not really well believed or well accepted recovery. People are still going to be very hurt, very skeptical of risk assets, especially. But that's when you want to buy. That'll be finally the time to get back in. And I think we're going to have nice days late 2023 into 2024. I think we're going to be all kind of happy and living better days again.
Yeah, and right at the timing of the next happening for Bitcoin, so good timing there. I think cyclically, when you look at that for sure. Speaking of Bitcoin, Bitcoin seller exhaustion now hitting a 4-year low in what we've seen as to be a very typical bear market. Now, some people have looked at this. I've talked to many Bitcoin advocates and that really follow the 4-year cycle, almost to a religion standpoint. And one of the things that had to occur for the 4-year cycle to kind of hold in place would be a pivot around now, right now, in the sense of being able to leverage up and being able to, apply the 4-year cycle with that. Do you think we bust out of the cycle for what's happening within Bitcoin itself and we kind of deal with some new economic measures for what the future of Bitcoin holds?
Great question. I actually, I sort of raised the hackles of some of my fellow Bitcoiners, especially my maxi friends, and I'm kind of a borderline maxi, but I think that the 4-year cycle is dead, actually. I think that was related, that's the early year phenomenon of Bitcoin that was related mostly to the fact that the miners were the ones holding the most Bitcoin. And as we had the halvening process, it got less profitable for them. So they needed to do major CapEx things. They needed to sell tons of Bitcoin. They needed to upgrade their miners, blah, blah, blah. We're not in that phase anymore. Most of the Bitcoin is now distributed across the world, and miners themselves, even though they're really struggling right now, they just don't hold that much Bitcoin relative to the overall pool of Bitcoin. And so, and they have access to the public markets for the first time this cycle that they didn't have previously. So that's just a really long way around to say I don't really think the 4-year cycles matter. But to your point, the timing of this business cycle, I think, will coincide with the next Bitcoin cycle too. So I think people are still going to say we're in another 4-year cycle.
Yeah.
Because I do think we're going to have a pretty significant bull market rally as we head into 2024, 2025.
Well, based on timing, it would, for at least from the math that I've done, when you look at historical comparisons to the last 2 Bitcoin halvenings and the cycles in which those existed, and even with kind of a market-adjusted comparison where those cycles shorten, even at that case, then we would probably enter into it in a much later position around what you and I both think, which is toward the end of next year, which would start to lean in the essence of a bottom. Now, obviously, what 2024 looks like is going to be a very interesting situation. Obviously, too many global macro scenarios playing into this that could really kind of adjust that. But yeah, it's a very interesting time right now, Jeff. That's for sure.
If I can just say, Paul, it's interesting the way the cycles have correlated with this. But I look at, I'm a macro guy. I look at everything from sort of a top-down approach and how that affects different asset classes. The number one factor for me for how different asset classes, basically risk-on assets versus risk-off assets, perform is global liquidity. So when global liquidity is expanding, that goes into risk assets, and Bitcoin has been the primary beneficiary of that. It also goes into crypto. It also goes into stocks, as we know, Cathie Wood's, ARK, those kind of things. When we're in a period of global contraction, monetary contraction, like we are right now, liquidity contraction, it just sucks the life out of all of that stuff. And to me, it's just honestly that simple. As long as we're in a recessionary business cycle and liquidity around the world is contracting, risk assets, you just have to avoid them. You either short them or you just get out and you stay out and you sit in cash and wait for the dust to settle. So I think by the next time, like when we're talking late 2023, 2024, we're going to be hopefully, I think, back into a global liquidity expansion phase again. That's the time to go into these kind of risk assets. That's the time you make these life-changing gains, but we're not there yet. We're not even close.
Yeah, and I think everybody needs to pay attention very closely to what's happening in Europe because they are ahead of us right now, and the potential of their participation and their contribution into that global liquidity is going to be very key. So obviously how they make it through this winter, the scenario with energy scenarios, obviously the situation with the war, all those things play into it. So 2024 is going to be a big one. So you got to stay on top of all this stuff as an investor, or even if you're just sitting on the sidelines right now and you're trying to kind of graph out your next moves, these are the kind of things that you cannot sleep on in the market for sure. Jeff, it's always fun jumping in with you. I want to jump to a poll real quick and then we'll take a look. All right, will Bitcoin crash this weekend after the Fed meeting yesterday? People are saying no, they think it's going to hold up right where it is right now, above 20K. What are your thoughts on that? You think we're going to see a little bit of down run?
I think we're in the bottom formation of Bitcoin and we're going to kind of crab sideways for quite a long time. I will say, however, like I still think equities have much further to fall. I've been saying for a while that I think the NASDAQ falls at least 50% from its highs. So I think it goes at least down to 8,000, maybe more. If that happens and if we have a floor dropping out moment, a capitulation type moment, I think it will suck Bitcoin down with it. And so Bitcoin may go sideways and be really resilient and keep holding on there and keep hanging in there. And then it just might have this one moment where it gets sucked down because everybody's getting margin called and they need liquidity. So I would not be surprised to see a wick down or to surprisingly low levels before this is over.
Keep a close market on that too, guys. We're going to be continuing to track all that along with sentiment data, all that good stuff for you guys. So here on the show, Jeff, always great having you. Thank you so much for stopping in today. We appreciate it.
Thanks, Paul. Anytime. I love being here.
You bet. All right. So you guys are tuned in over on the podcast, maybe after our live stream. We do live streams, try to do it daily. We're pretty much on track, but we have a big 3 o'clock coming up that you guys need to watch because it's going to be a good one. And it's all about Twitter and kind of the future of where we may see crypto and Bitcoin starting to move into a very interesting spot. So make sure and stay tuned for that. Hit the like button on these videos because it does help us out and it also helps spread the news to others who are starting to learn, maybe for the first time, about assets like this in terms of tech, Web3, crypto, Bitcoin, all that good stuff. You guys want to reach me? It is on Twitter at Paul Barron. We'll catch you next time right here on TechPath.